Finances and Early Withdrawals from an IRA with Kathy Pfeffer-Hahn. Finances and, in conjunction with my company, Capital Coaching, helps people achieve their financial goals through tailored, personal, attentive financial coaching services. Together, we'll create a successful financial plan by examining your spending and saving habits, then guiding and educating you to your own personal success. Coaching services include evaluation of your spending plan, building for your savings, financing your retirement, examining your insurance needs, and planning for your individual goals. Please contact me at capitalcoaching.net to make an appointment for a free consultation. I'd like to thank Debbie for the idea for this episode as well. What exactly is an IRA? It's an individual retirement arrangement, now also called an individual retirement account, where the individual person sets aside money, tax-free, to grow for their retirement. This is very similar to a 401k or 403b, but in this case, your employer is not setting it up or funding it. You're able to contribute up to $6,500 a year, plus an additional $1,000 if you're over 50, called a catch-up contribution. This additional $1,000 is to help those closer to retirement catch up on their retirement funds. You may also qualify for a tax deduction for money that you put into your IRA based on many factors, like if you already have a retirement plan at work or don't, what your filing status is, and your modified AGI or modified adjusted gross income. If you have an IRA and need money, it can be tempting to want to take money out of that IRA and spend it. It can also be hard to look at that balance and remember why you're leaving it there to grow, because retirement can seem so far off. There are many reasons, though, why you should not take it out. One is that you'll owe taxes on the amount you withdraw, and you'll also owe big penalties if you take an early withdrawal, that is, a distribution before you turn 59 and a half years old. The reason the IRS does this is to try and make removing money so distasteful that you want to keep it in your account. This money has been put aside to fund your retirement, and although that seems far off, it's meant to encourage you to keep the money in there and let it grow. The penalty of 10% of what you take out does not apply to Roth IRAs, only traditional IRAs. This is because the money that you put in a Roth IRA was already taxed, where an IRA or traditional IRA have funds that were added with pre-tax dollars. So how much are we talking about? If you were to withdraw $10,000, you'll owe $1,000 in penalties. Withdraw $100,000 and you'll owe $10,000 in penalties. You'll also be taxed on the amount that you withdraw. It's not uncommon for the amount that you withdraw to move you into the next tax bracket, meaning that you could owe more in taxes on your overall earnings because your adjusted gross income was just increased. Roth IRAs have different rules because you have to use taxed money to fund it. You can withdraw the money that you put into the account, called contributions, without any tax or penalty, but the earnings that have grown while in that account is taxed. Of course, you're still removing the money that you had planned to help fund your retirement, and that can be dangerous. Withdrawing any of the money earned will cause the same 10% penalty as a traditional IRA, but not the taxes, because as I've said, you've already paid those before you funded the IRA. The IRS does allow you the ability to repay yourself within 60 days of borrowing it, penalty-free. But after 60 days, you cannot, and your retirement fund will miss out on the money that you've been socking away. If you did borrow against your Roth in the tax year of 2020, then you actually could have borrowed $100,000 and then had 3 years now to repay it without penalty. This was specifically meant to help you during COVID. Roths have the ability to avoid any taxes or penalties for some very specific exceptions if it has been at least 5 years since you first contributed to that Roth. These might include withdrawal at 59 and a half or older, you have incurred a permanent disability, the withdrawal was made by your estate or beneficiary after you pass, or you use the funds to buy, build, or rebuild a home that meets first-time homebuyer exceptions. There are 7 exceptions where you can avoid the penalty, but not the tax, from either a Roth or a traditional IRA. The first is if you use the money to take out a series of substantial, equal distributions. This is the exact reason that you want to consult a certified financial advisor. You don't want to make a large mistake here. Another possibility is any unreimbursed medical bills that will exceed 10% of your adjusted gross income, or anyone who does not have health insurance. The medical bills must be paid the same year as you took the withdrawal. Unfortunately, that 10% threshold is actually very high. The example that's on Investopedia is that if your AGI is $100,000 and your unreimbursed medical expenses are for $15,000, you may take $5,000 penalty free because that is the amount above the 10% of your AGI, not the whole $15,000. You can also use the IRA borrowed money to pay medical insurance premiums after you lose your job. You received unemployment payments for 12 consecutive weeks. The distributions were taken the year that you received unemployment payments or the following year, and the distributions are received no later than 60 days after going back to work. Another way that you could use these funds is if they're used to pay an IRS tax levy if you have unpaid federal taxes. If you're a military reservist or a National Guard member and are called to active duty, and you serve more than 179 days, you can also withdraw from your IRA penalty-free. This exception also has a longer repayment window of 2 years after active duty ends versus the 60 days. The final exception is for qualified higher education expenses. These include books, tuition, fees and supplies for college, university, or any post-secondary institution. Room and board are also included if you're enrolled at least half-time. These funds can come from the student's, parents', spouse, or even friends' Roth IRA accounts. Before you withdraw any funds, you can log on to TIAA's Early Withdrawal Calculator and see if it's worth it after all. Just playing with it, I put an amount in to withdraw and my annual salary. It calculated that I would lose $44,000 in taxes and penalties if I took a withdrawal. Oof. The bottom line is that no matter how much you withdraw, no matter the amount, you're going to lose the ability for those funds to do their job and grow. I found an example on Dave Ramsey's site where $50,000 is taken out, and after penalties, they had only $30,000 to spend. And an example where that same $50,000 was left in the IRA and let to grow at 12% for 20 years, they had $544 to spend in retirement. Can you truly afford to have less? Most of us can't. This is Kathy Pfeffer-Hahn. Thanks for listening to Finances and Early Withdrawals from an IRA. I know you chose to listen and I'm grateful. If you enjoyed this episode, please follow or subscribe for free in your podcast provider and share your favorite episode with a friend. I would really love you to leave a review because it brings financial education to others and helps people find me more easily. Also, be sure and share what questions you'd like answered or any topics that you'd like covered, like Debbie did, by going to the website at financesand.net and leaving a message. You can also contact Capital Coaching for your personal financial needs at capitalcoaching.net. Finances and does not provide tax or legal advice, and nothing in this podcast is to be construed as such. Always consult a tax, accounting, or legal professional for advice on your specific situation. Remember, I went to school.